Learning objective 3 looks at the exact same invoice, but from the seller's perspective. And so, what does PW Audio do in this situation if you're the PW Audio bookkeeper? You saw Sock Stereo buy $3,800 worth of merchandise from you on the 4th of May, 2017. Well, this is a sale. This is a sale. So two things have to happen every time there's a sale. Okay. The first thing that has to happen in terms of you have to journalize the sale. So that means that you're going to be debiting, in this case, because it's an invoice, you're going to be debiting accounts receivable and crediting sales revenue because that's the first thing you do. But stop and wait now. It's not the last thing you do because you just sold some of your inventory to another business, okay, or to a customer. So the second thing you got to do is record the cost of that sale and take it out of inventory. So there's two steps. Every time a sale is made, you're debiting either receivable or cash, crediting service revenue. Then you are taking another look and say, okay, I have a cost of goods sold because I owned it before I sold it. So what's the cost? And I'm going to take it out of inventory. So these two things is the first thing you do to record a sale. So PW Audio just sold $1,300 worth of stuff on the 4th of May to Sock Stereo. And this is where it gets interesting because now you're going to find out that the cost of that is $2,400. Okay. So again, step one, record the sale. Step two, record the cost. So the first thing you're doing is recording the sale. You just sold $3,800 worth of merchandise to Sock Stereo on account, which means you gave them an invoice. That invoice is an accounts receivable to you, debit accounts receivable, create a sale, credit sales revenue. But now you have to record the cost. You just sold $2,400 of your inventory to somebody else. So now the second thing is I have to say $2,400 have been sold, cost of goods sold. $2,400 of inventory is gone. Crediting inventory takes it out of your inventory. So that is very important. That's very important. Well, you know what happens. Sock Stereo opened the box and said, I don't want this circuit, and they sent it back. So to the buyer, it's just a return of inventory. To the seller, they look at it differently. They take it a little bit more seriously from an accounting perspective, okay? They actually set up a whole special account called sales returns and allowances. It's an actual revenue account. So literally, it's a revenue account. However, it's a contra revenue account because the revenue account would normally have a credit balance, but sales returns and allowances has a debit balance. Remember, the word contra in accounting mean an account with an opposite normal balance to all the other accounts. So a contra revenue account would mean, okay, revenue has credit balance. If it's a contra account, it has a debit balance, just the opposite. So we look at these returns very seriously because retail, merchandisers are not in the business of selling shit just to get it back, right? I mean, it's a real pain in the you know what for them to do that. So they need to really keep track of their returns, and I think that's very very important to understand. They're in business to sell stuff; they don't want it back. If they keep getting back similar stuff, they shouldn't really be having that in stock. They shouldn't be having that on the shelf. And the only way they're going to know what's coming back is to sort of separate things and keep track of that separately. So it's a very good idea for businesses to do this. The actual sales revenue isn't reduced. Sales revenue is not affected. Sales returns and allowances is affected. Okay, so we look at it. We don't want to distort anything. So let's take a look at how this works. Remember that Sock Stereo opened the box, and then decided to send a circuit back. PW Audio got the box. Here it was, oops. You guys still on a PowerPoint slideshow with me? Okay, because I just got my thing just shifted a little bit, sorry. They just got a box with a circuit back that they sold for $300. Well, what do they do with it? Well, in most cases, they can sell it to another company. That's not illegal or wrong to do, particularly if the good is not defective and it can be used. So what they have to do is they have to show it as a sales return allowance, this $300 coming back. And then because they had a cost of 140, they're going to have to put it back in their inventory because they can sell it to somebody else. So the first thing they do here is debit sales returns and allowances for that $300. Look, sales returns and allowances, debit side. And of course, they're not going to be receiving any money for that, so they're going to have to reduce their receivable. But now they have to put it back in inventory and sell it to somebody else. So they're going to debit their inventory account, and they're going to take it away from the cost of goods sold. This is where cost of goods sold is a little bit interesting, because up until this point, all your expense accounts are, debit, 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 debit. You understand? It's almost like a frog. What would you like to do with this? Debit, debit, debit. You'd be debiting expense accounts. Cost of goods sold is one of those interesting expense accounts because it is a normal debit side. However, in merchandising and retail, because there's a lot of goods that are coming back that are really good to sell to other people, you don't have to throw them away. You'll put them back in inventory, but you have to take out the cost of goods sold. Okay, so this is one of those accounts, even though it's an expense account, it'll have an active credit side as well. Okay. Oh, exciting. Well, this is, of course, it's a textbook. It's important to kind of understand that sometimes things are defective. We live in a time where defection rates are very, very low. It really depends on the product. The more complex the product is, obviously, the more risk there is that something will go wrong. But because we have, for a long time ago, committed to computer-aided manufacturing and computer-aided design, we've gone to robotics and other types of things for manufactured products. The defection rate on any of those things is extremely low, much, much lower than 1%. So it's very rare that we would have a defective good returned to us. However, it still happens. It still happens. And so if you got a good that's defective, how would you deal with it? Well, usually stores would put some type of a scrap value on a defective good, a special value. I don't like if they use 50. I'd rather use an odd number like 9 or 19 or something that kind of sticks out to show that this particular return was defective. And that's a good reason to return something. So if it was defective, of course, they can't sell it to anybody else. So they're going to have to either return it to the manufacturer. So the manufacturer understands that and they usually will get it replaced. Or if they are the manufacturer, they're going to, that's going to be another interesting story. That's why that got up on the shelf. So they will show the sales return for 300 and take it out of receivable. However, they will not resell it. So they put it back in their inventory for a very strange scrap value number. Like I said, I prefer, excuse me, I prefer something like 9 or 19 or something ridiculous. Macy's uses a penny, for example, and cost of goods sold would also need to be reversed to some degree to show that that's a defective piece of inventory that was returned. Okay. Well, what if the buyer decided to take the discount, pay within 10 days, and sent us less cash than what we were thinking? Well, that's a whole other account. That sales discounts is another revenue account. But like sales returns and allowances, it's a contra revenue account, which means that it has a debit side balance. Okay. It's important to collect cash early. So having a sales discount is not a bad thing. Um, you get the cash much earlier, which is better. And so, it has an effect. But sales discounts is a revenue account. So look how many revenue accounts we have. The sales revenue account, which normally is a credit side balance, as you know. But then you just learned about sales returns and allowances, which has a debit side balance. And now you're learning about sales discounts, and that also has a debit side balance. Both sales returns and allowances and sales discounts do end up shrinking the net sales, but doesn't take away from the fact that this company started with a $1,300 sale. Okay, it doesn't take away that fact. And then certain things were returned, certain things were discounted. What you'll see on all the income statements of companies, particularly larger companies, the income statement will start with something called net sales. And net sales is basically this formula: sales revenue minus sales returns and allowances minus sales discounts. That'll get you to what we call net sales. And this is something that you have to know. And this is something that you'll see on all those income statements if you ever look at an income statement from a merchandiser, and we will. So you'll see it. Okay, so Sock Stereo here owes $3,500. And they're going to pay on the 14th, which means they're going to take a discount. How does PW Audio handle it when they get the money? Well, they're going to get $3,430 cash. So they're going to be debiting cash. They're going to take the sales discount of $70. Again, it's a debit side account. And show that that whole $35 receivable was paid. Okay. So we are at the end of this story. And we're going to go back to our relationship between De La Hoya Company and Juno Diaz Company. Juno Diaz is the selling company. So we're going to be looking at this from the seller's perspective and doing the bookkeeping from the seller's perspective. So we might remember on the 5th of September, De La Hoya bought merchandise on account from Juno Diaz. They bought $1,500 worth of goods. However, the cost to Juno Diaz was only $800. And then 3 days later, on the 8th of September, they returned goods for $200, but the cost was $105. So we have to do two things. Do the bookkeeping for what happened on September the 5th, which is to record the sale and record the cost. So the first thing that happened was we made a sale on account, $1,500 debit to receivable, $1,500 credit to sales revenue. But remember, we have to record the cost. So we're going to debit cost of goods sold, $800, because that was our cost. Credit inventory, $800, so we just sold all that inventory. 3 days later, we got a return, right? So how do we handle this return? Well, we are going to debit sales returns and allowances by $200. And we're going to take that away from our receivable because we're not waiting to receive that anymore. It's been returned. This is still good merchandise. It can be sold to somebody else. So we will put it back in inventory at $105 cost and reverse our cost of goods sold for that amount as well. Okay. Questions?